Value Investing Trap 2: Investment in Property, Plant and Equipment. In the first episode of this series, I stated that you better watch carefully where your retained earnings go. Every dollar retained in the business and not paid out to the shareholder better increase the future value of the firm. However, quite a few businesses seem optically cheap but never seems to get recognition from the stock market. One of the reasons why a company may seem cheap on the surface but always seems to trade sideways is because of retained earnings being reinvested into property, plant and equipment. Property, plant and equipment are a company's fixed tangible assets. Think about a factory that produces your inventory, the land that the factory is built upon, and the machines that produces your product. PP&E investments are often some of the worst kinds of reinvestments. A machine deteriorates over time, needs constant fixing, may have downtime, and must be replaced when it is too old. Furthermore, it may be technologically obsolete after a couple of years, and the economic value of the machine may be lower than the book value of the machine. Needless to say, reinvestment into equipment may be a very lousy investment. Let's do a quick numerical example. Take a firm that earns 5 million in profits. The firm takes those 5 million and reinvests into the business, into new machinery. This will increase the output of the firm. After 5 years, however, the machine is obsolete and needs replacement. The company needs to again reinvest part of the profits into new machinery. The profits of yesteryear never reaches the shareholder as cash in hand, but simply keeps the wheels in the business running. This is what Buffett realized when buying Berkshire Hathaway. All profits had to be reinvested into property, plant and equipment and was never able to pay dividends to the shareholders. As the famous Charlie Munger quote goes, "There's all my profits rusting in the yard." The profit sits in new equipment and machinery that keeps the business going but never produces excess cash. When a company buys a machine, it's normal to depreciate it over perhaps 10 years. Well, let me tell you, a lot of things can happen in 10 years. First of all, a machine may simply depreciate faster and may need replacement after 6 or 7 years. In these cases, we need to write down the asset and book a cost higher than the depreciation. Other times, however, a competitor arises and uses a new machine that produces similar products to our company but more efficiently. They may be able to lower the prices. If our company is going to compete, we also need that new machine. So, despite our current equipment working and as many years of depreciation left, it may be obsolete. The economic value is lower than the book value, and we need to buy more equipment. This is why some companies has higher capex than depreciation and amortization. A company may look profitable on the surface, but the cash flow statement tells a different story. Every year, there seems to disappear a lot of cash out through the cash flow statement. A company may produce accounting profits, but let me tell you, there's little economic value being produced. A classic value trap where earnings are higher than free cash flow. Okay, so that's the deal with machinery. You need to invest in them upfront, depreciate the cost over time, and when the day comes to reap the rewards, then the machinery must be replaced by new equipment. So what about property and plant? They may seem like better economic assets when compared to machinery. They don't depreciate as fast, and land even increases in value at times. Surely, these are better uses of retained earnings. Well, perhaps, but certainly not always. A land may appreciate in value over many years. Perhaps the factory is placed on some very valuable real estate that the company may sell for a solid profit in the future. Who hasn't been pitched a stock where a company is supposed to own some great real estate assets that has a higher sale value than the accounting book value? Well, let me tell you, this is one of the most classic value traps in the market. Such assets are very unlikely to be unlocked by the company. Management in most companies do not think like investors, nor should they. They run a company, has focus on customers and employees, and sometimes has shareholders as the least valuable stakeholder. The fact that a company has valuable real estate assets or other assets shouldn't be too interesting for investors. Sure, is there a catalyst, a new CEO that wants to unlock value, or a takeover bid looming, then the situation may look different. In most cases, however, the valuable assets will sit on a company's books for longer than the shareholders would like. It may help you pay down a loan if there's a bankruptcy, but to an investor, all equity will be wiped out in such an event. A company constantly reinvesting cash into property, plant, and equipment just to stand still is not creating value. The return on invested capital is below the cost of capital. Thus, the company is destroying value. Every retained dollar is reinvested at poor rates of return. A capital-light business that can grow without big capex requirements and large PP&E reinvestments has a much easier way of creating value. Compare a steel manufacturer to a consultancy firm. Both firms may produce 100 in earnings. Both firms may grow only 5%. The steel company may trade at 5 times earnings, and the consultancy firm may trade at 20 times earnings. Every introductory investment book tells you to buy the cheapest company. It's cheaper and grows at the same rate. But every year, the steel company must reinvest all earnings into new machinery. Some years, they even need to buy new land to build out the new facility. There's never any cash left to distribute to shareholders. The consultancy firm, however, doesn't need to retain anything in order to keep growing. They can pay all earnings as a dividend, corresponding to a 5% yield. How may the company grow, you may ask? Well, it doesn't require any cash in order to hire a new consultant. They're paid for their work and increases profits for the firm without any reinvestment needs. Surely, this example shows how accounting earnings doesn't tell you whether a company is cheap or not. Be aware of the places the retained earnings go. Reinvestment into property, plant, and equipment is the source of many value traps. As a final point, I want to emphasize that there is reinvestment in PP&E that actually creates value. We must determine whether all the cash outflows in the cash flow statement goes towards maintenance capex or growth capex. Take a company like Walmart. For decades, the company had strong accounting earnings, but seemingly poor free cash flows. The stock price kept appreciating and was a fantastic investment. How could we know in advance whether Walmart's capex into PP&E actually created value? Well, you need to work out the incremental return on capital. You need to understand the unit economics of a single store. You need to understand whether a store concept in a given market will work in a different state, region, or country. The answer to all these questions does not lie in an Excel sheet. There's no exact formula or answer. In danger of boring you with another investor quote, many investors calculate too much but think too little. When Walmart first started out, it wasn't easy to know whether the company would become what it is today. But after 10 plus years of the concept working in different states and the return on invested capital proving to be stable at a strong level, then it didn't take a genius to know that the compounding would continue. You should know that Walmart is the exception to the rule. Most concepts doesn't translate too well into other markets. A restaurant concept may work perfectly in Washington, but culture may mean that it doesn't work in New York. A retail store may work in Germany like Lidl did, but doesn't work in Norway. You cannot assume that a high return on invested capital will correspond to a high incremental return on capital. Walmart is the exception, not the rule. To wrap up this episode, you need to ensure that every retained dollar creates additional value. Think of a business as a slot machine that produces cash. When the machine produces cash, where does the cash go? Sometimes you have a business where you need to put all that cash back into the business. This is maintenance capex and has a lousy return. Sometimes you have a business where you need to use the cash in order to make the machine larger. Then the machine will produce more cash in the future. This is growth capex and may or may not be valuable. To determine this, you must understand the unit economics and try to estimate the incremental return on capital. Sometimes you have a business where the company grows larger and larger but still produces cash along the way. This is a company that grows without any reinvestment. This is the most valuable form of compounding. If you find one of these companies, you better pay close attention. This episode centered around the second value investing trap, investments in property, plant, and equipment. Please interact with the podcast if you'd like additional episodes on the topic. Thanks for listening.